everything that's wrong with the National Retirement Risk Index and their Retirements at Risk study and surveys that they do since 2004 and every couple years since. This whole thing is nuts, and so many people fall for it. I hate it. I don't know why. I don't know why this gets top shelf info when it's just there's so much that is wrong with this. And these are researchers from Boston College, Center for Retirement Research. It just is nuts. So let's dive into this a little bit. It'll give you a breath of fresh air for all the crap you're hearing. I just listened to a Morningstar podcast from Christine Benz was interviewing William Bernstein, who's very well known in my realm, financial planning. Very well. Does he get the Nobel Prize? I don't know, but very well known guy. And even he sucker for this stuff. I'm like, what is it, man? What is it with everyone who needs to create a crisis that does not exist? If there were a crisis, there'd be breadlines. They're not breadlines. Well, it's easy for you to say. No, they're not breadlines. Stop. All right, so let's just dive into this. All right, so we're going to go into this, and I'm just going to read you what my, this is the 35-pager. This is going to take some time, and then we're going to read you this from 2004, and then we're going to read you the update from 2018 as well. So hang in there, man. This is important stuff here because when you hear 50% of Americans are at risk for retirement, this is what they're referring to, and we're going to kill it here. We're going to kill it once and for all. What we used to call in the Army double tap. I don't know if you can do that anymore. But anyway, I never did it. But in terms of what the soldiers are trained. All right. The National Retirement Risk Index, it measures the percentage of working age households who are at risk of being financially unprepared to retire by 65. It is calculated by comparing projected replacement rates for a nationally representative sample of households with target rates. The target rates would allow the household to maintain its pre-retirement living standard in retirement. So it's going to maintain its pre-retirement living standard in retirement. That doesn't sound bad, right? Well, let's keep hanging in there with me. Don't get away yet because there's well more to come. If a household falls short of this target by more than 10%, it is considered at risk. I'm not going to go into this yet because there's lots of other things. All right. The results of their study show that even if households work to age 65 and annuitize all their financial assets, including the receipts from reverse mortgages on their home, the 43% of the people would be at risk. And now it hasn't been 2004, and now it's like 52% of the people. So remember, that should draw, So three things automatically should jump out at you. Projected retirement income as a percentage of pre-retirement income would allow households to maintain its pre-retirement living standard in retirement. Pre-retirement living standard as measured in income. That's a false flag. Part two, we're going to annuitize all our financial assets, including receipts from a reverse mortgage. That's 2 and 3 false flags. And then we're going to talk about what they do with the annuity as well, which is just horrific as well. All right. In the case of early boomers, 35% will probably not have enough to maintain their living standard in retirement. Again, living standard in retirement is based on what? On income pre-retirement, which is that is not that is not 100% positive correlation. Your income pre-retirement does not equate to your living standard, if that makes sense. Stay with me. The figure increases to 49% for Generation Xers. And again, there's another reason for this, which is nuts. Those with low incomes are more at risk than those with higher incomes, and those without pensions are more at risk than those with either a defined benefit or a 401k plan. And this is just a chart that shows Generation Xers at 49% risk. If you're in the bottom third of income, you're at 60% risk, which is in of itself insane. So we'll go with this. This issue is particularly important now because while many current retirees are doing quite well, the retirement landscape is changing rapidly. These changes make the outlook for retiring baby boomers and Generation Xers far less sanguine. Sanguine? I don't know what sanguine. Unfortunately, many current workers do not appear to understand the nature of the problem and are likely to confront in retirement. And I just say we want to thank Nationwide for exclusive support of this project. Thus, in my opinion, why they talk about the annuitization of all assets. Interesting, because Nationwide is an insurance company. Anyway, I just find it funny. So back then, most retirees were doing fine in 2004. But we also I've done videos on before, we had retirement crisis issues back in the 80s, 90s, the whole thing. Now we fast forward 15 years and we still have no retirement crisis. All right, so even though back then people were doing fine, the future, like everyone can be destitute. And we have no evidence of that because now we have 16 years of track record and we still have most retirees doing just fine, as witnessed by various surveys all over the place. All right, let's keep going. All right, so let's keep going here. This report first describes the construction of the National Retirement Index, which involves two separate steps. Projecting retirement replacement rates for each household and determining a target replacement rate. All right. Projecting retirement replacement rates involves two calculations. The first is estimating how much income households will have as they enter retirement. The second is estimating their pre-retirement income. All right, let's keep going. All right, so the index does not include income from work since labor participation declines rapidly with people as they age, but yet so they're not including 25% of people over the age of 65 work and have an income of some amount, but none of this is included in the National Retirement Risk Index. So you can see here. So one of the things they're not doing, they're not including income from labor once you're over the age of 65. And yet if we look here, 25% of people over the age of 65 actually work. And that's not included in the National Retirement Risk Index. Let me just read that again. It does not include income from work, since labor force participation declines rapidly as people age. Yet 1/4 of the population is working for an income. Then they talk a lot about wealth to income ratios. And I say, and I'm not going to get into this, just the specifics of, look at these, it's nuts. Wealth to income ratios are simply dumb to use a retirement income analysis because income is only thing that matters is the income you have coming in, which is derived from how much you have going out. It has nothing to do with the wealth to income. And I have people all the time, pensions and Social Security, they have no, let's just say they have no income or no wealth because everything is in pensions and Social Security. They're not running out of money. So the wealth to income is low because they have no wealth, but they have income. To use wealth to income and retirement income projections is just as stupid. It's dumb. Don't do that. And they do this all. It's just nuts. All right. Let's keep going. All right. Having completed the projections for 401k wealth and financial wealth, net of non-mortgage debt at retirement, the next step is to estimate how much income that wealth will produce. Excuse me. Oh, hold on a second. The assumption is that households will purchase an inflation index annuity. It was so hard I had to take a break to get some water because I made myself sneeze and I was crying a little bit. Anyway, the assumption is that households will purchase an inflation index annuity. That is an annuity that will provide them with payment linked to the CPI for the rest of their lives. For the love of all that is good in this world, do not buy an inflation index SPIA, a single premium index income annuity, or immediate annuity, however you want to call it. Do not do that, please. I've done videos on this before of how much you're sacrificing on the front end in order to get inflation adjusted amount in the back end. And usually, I can't remember what it's like, when you're 85 or something like that is when you hit the break even. And the vast majority of us will not survive till 85. Do not get an inflation index annuity, please. It's literally, you start so low on the income stream. Most of us are going to die before it even comes to where it would break even. There's a break even point that if you live in your mid 80s and late 80s, you'll be glad you did the inflation index annuity. But you're living on such a sparse amount on the front end, it's just not worth it, man. Housing. In retirement, homeowners can receive two types of income from their home. The first type of income is the benefit of living in their home rent-free, what economists call imputed rent, which I talk about all the time, that your home is not an asset. The hell it's not. Home is an asset. Because if you have your home paid off, you don't have to generate income, which is taxable, by the way, in which to pay the mortgage. Now, you still have to pay property taxes. I get that, but you can live in a cheap property tax state and you're good. Your home is an asset. And I do like the fact they talk about imputed income. Imputed income is the money you don't need to generate to pay a rent or a mortgage. And that money is subject to tax. Drugs. All right, so we talk about imputed income. Let's keep going down. All right. Home ownership and mortgage debt by age of a household. So just remember, and I agree with what they're saying here, mortgage debt, it can be a concern in retirement. In fact, I say all the time, number one thing you can do and go to retirement successfully is have all your debt paid off. Someone's very upset with me for having Pablo in the video. She goes, I can't believe you let him lick you. And I just want to say, he's my man, so he can lick me all day you want. You want to lick my cheek there? She goes, he just licked his blah, 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 and you let him lick you? I said, yeah, I am, absolutely. All right. Home ownership and mortgage debt. So I want to show you something. Between the age of 65 and 74, 81% of that cohort have own a home. The median value, and again, this is 2004, the median value is 150. The percent of homeowners with a mortgage was 39%, and the median value of the mortgage is 51%. So I just want to show you something. 81% of this cohort owns a home, of which we'll just say 40% of that 80% have a mortgage. Of that mortgage, more than half have less than $51,000 because median is 50% more, 50% lower. So median is half of the 40% of the 80% who have, or are 65 to 74 who have a home, have less than $51,000 in their mortgage. That's not an extraordinarily high balance, my friends. It's just not. So the point about that is you might need cash flow to cover that debt. You can easily do it in a myriad bunch of ways in terms of reverse mortgage, all kinds of things, or just keep paying it off because it will be paid off sooner than later. I just wanted to point that out. That is not a horrific number by any stretch of the imagination. All right, so let's keep going down here. All right, so when anything I missed here? Social Security. All right, sorry, right here is big. This is huge. This is huge. When calculating Social Security benefits, it was necessary to recognize that Social Security faces a financial shortfall. The system can pay benefits, full benefits, until 2040, when I was 2034, after which current payroll taxes will only cover about 70% of benefits promised. So again, 2004, the system was solvent until 2040. And when I say solvent, it doesn't mean it won't pay anything. It just was solvent in the regard that it could pay 100% of promised benefits. Now it's 2034. But the decision was to assume full payment for those who retire until 2040 and only about 70% thereafter. You hear what's going on here? They are saying 70% of the money you receive in 2040, you're only going to get 70% of your Social Security benefit from 2040 and beyond. So you take Josh, I'm a Gen Xer, and I have $1,000 in Social Security. I retirement, and when I'm 65, I'll get $1,000 a month. We'll just use that for example because I'll be 65. I won't get $1,000 a month, but just use that for example. When I hit 70, when I hit 2040, in which case I will be 70, at 2040 though, that will be reduced by 30%. Does that make sense? That means I'm only getting $700 on the $1,000 that was initially promised. Why is that a big deal? Because if you actually think the government and the politicians are going to cut your Social Security benefit by 30%, you're freaking nuts, dude. There's no other way around that. You're nuts. It's never going to happen. It's never going to happen. But they're assuming that it will happen. And I say that's nuts. Now, how else would you assume? Well, the whole point about this is why not state that like this? I mean, they state it, but you have to read the fine print, which I guarantee Bill Bernstein and all the other naysayers don't, from Market Watch and Motley Fool. It is assuming you're going to get a 30% pay cut in your Social Security from years 2040 and beyond. Just show me at any time when the government took away money from the biggest voting bloc out there, which is retirees. Never happened. If no new legislation is enacted, the workers who turn 65 in 2040 or thereafter, as well as who are already retired and drawing benefits at that time, will receive only 70% of promised benefits. And that is what they're using the National Retirement Risk Index. Nuts. All right, so we're going to estimate pre-retirement income. Now, here's something that just... The items that, so remember, we're estimating pre-retirement income to get us to the gauge of how much income we need based on the pre-retirement income to get a gauge of our standard of living. The whole thing is just, it's crazy, but that's what we're going to do. We have this amount of pre-retirement income today. We need that amount when we retire. The items that comprise pre-retirement income include earnings, work, the return on 401k plans and other financial assets, and imputed rent from housing, which is net of interest paid on mortgage debt. We're using earnings on 401ks and imputed rent as a pre-retirement income? That doesn't make any sense to me at all. I don't get that money to spend. That has nothing to do with my standard of living today. Nothing at all. I mean, you could say, I guess, you would say, imputed income on a house does, but that why? Because if you have imputed income on a home that's paid for now, that's going to carry forward into retirement. Why would that be part of the? I don't get why would that be part of the right here, the estimated pre-retirement income. Why would you use returns on 401ks? It's not going into my cash flow. It doesn't make any sense as my pre-retirement income. Why would you use imputed rent as my pre-retirement income? That just doesn't make any sense at all. I don't get it. In essence, with regard to wealth, income in retirement equals the annuitized value of all financial assets, net of non-mortgage debt and housing assets. Income before retirement is just simply the return of those same assets. What? It's just weird. The Survey of Consumer Finances provides limited data on historical earnings. Individuals are asked to state their current earnings and their earnings when they quit their job. Therefore, to construct earnings profiles, it was necessary to turn to the Health and Retirement Study from University of Michigan, HRS, which has a reliable historical record of earnings data. Median earnings histories were estimated separately for men and women. It was assumed that all men and women in the Survey of Consumer Finances had this average earnings profile. Given current earnings, all previous year's earnings can be estimated. Individuals reporting zero earnings were assigned zero earnings from the day they quit their last job. For those who reported earnings on both their current last job, if earnings on the last job differed from imputed earnings, then earnings for all previous years were adjusted up or down proportionally. All right, but listen to this. The earnings histories are then indexed to reflect the growth in wages averaged over the life of the household. Average annual income from wealth is calculated by applying a real return of 4.6% to pre-retirement assets. This number combined with average wage index lifetime earnings then serves as the denominator for each household's replacement rate. So what they're doing, they're taking your average earnings, which is silly, man, because you have the $15,000 you made as a private Joe Snuffy in the Army relative to the $200,000 you're making now. We're going to average that out, but we're going to index it. So we're going to have less index on the $200,000, more index on the $15,000. We're going to average that over a course of your life, and we're going to say this is the pre-retirement income you need. That doesn't make any sense. Because what's being skewed here? What's being skewed is the higher numbers are going to bring up the average more. And so what they're saying is, look, we're going to take all these years of employment, we're going to average them, adjusted for cost of living adjustment, average wage index, and all that. And we're going to say that is your average income. And that's for the base we need for your target income. It doesn't make any sense. That makes no sense because it has nothing to do with your expenses. Nothing. It just says, here's your average income. You need to get a target percentage based on that. If you don't get a target percentage of retirement income based on that, you're failing. You're like, but that has nothing to do with my current level of expenditures. It only has to do with the income side of the balance sheet, of the cash flow statement. It has nothing to do with my, jeez Louise. For the cohorts as a whole, the median replacement rates declines from 77% for the early boomers toward about, replacement rates for households by cohort, income level, and pension coverage. For cohorts as a whole, their median replacement rates declines from over 77%. Let me just show what this is right here. All right. So what they're saying is median replacement rates at age 65 by birth cohort and retirement and household type. So they're basically saying for early boomers, they are getting essentially 77% of the replacement rate of their average earnings that they've had. For Generation Xers, we are getting 65% replacement rate on the average earnings that we had. That will mean something as we go forward. That is not the target. That's what they're getting on average. 65% Generation Xers are getting 65% replacement rates based on retirement income, which is reduced because the 30% decline in Social Security, annuitizing everything with an inflation-adjusted annuity and taking a reverse mortgage. We're saying all that's happening. All these things are silly, but we're going to say that, and we're going to say when it comes to the average income the Generation Xers have, they're getting a 65% replacement rate. That's not the target. That's a 65% replacement rate. All right, let me pause here real quick. We'll come back and do part two of this. Hold on just a second. There's so much more here.